Good morning, good afternoon or good evening, depending on when you're watching this webinar, and welcome along to the first webinar in our series on inheritance tax. My name's Andy Hogarth and I'm a Chartered Independent Financial Advisor at Hazlewoods Financial Planning. The past couple of years have been very difficult for all of us and have put things in perspective. It's reiterated the most important things in life, particularly family and friends. This has led many into reviewing their affairs and how best to ensure that their loved ones are provided for as best as possible. A key part of this planning has involved thinking about inheritance tax. Now, for many of us, the thought of discussing inheritance tax and for planning when we're no longer around can be difficult. However, by choosing to ignore this or delaying thinking about it, it can mean that tax is paid unnecessarily, or even worse, our estate isn't distributed how we would like it to be. It's sometimes thought that inheritance tax is complex or that it only affects the wealthiest in society, which again are further reasons why individuals don't address this area. Over the course of the next 3 months, we're going to release a series of webinars on inheritance tax. This will attempt to simplify this area and discuss why it's increasingly important to consider this, along with details of some planning options that are available. During this first webinar, we're going to look at the basics of inheritance tax. This will include what it is, who might pay it and when, how much it may be, and what reliefs may be available. During the second webinar, which will be released next month, we'll look at some simple, often overlooked planning options to help mitigate inheritance tax. This will include the importance of having a will in place, the benefits of gifting, and also pensions as an inheritance tax planning tool, as well as for retirement planning. Finally, during the third webinar, we'll look at further, slightly more complex planning for inheritance tax. This will include trust arrangements, business relief, and the importance of ensuring you continually review your inheritance tax position. So without further ado, let's look at the basics of inheritance tax. Inheritance tax has been around in one form or another since 1694. However, the current regime has been in place since 1986. Now, unlike many other areas of taxation, many of the core rules around inheritance tax, such as allowances, reliefs, the rates, have undergone relatively few changes over the past number of years. This means the principles of the tax are well established in UK tax law. Inheritance tax is generally levied on death, although there are certain times when a lifetime charge might arise. It's payable on an individual's estate which exceeds certain allowances. Included within the individual's estate is their property, their savings, most investments, and their chattels. But it's also reduced by any liabilities such as mortgages and funeral expenses. Some assets are also exempt, such as pensions or life insurance proceeds written under a trust. For business owners, the value of these are often exempt also. Inheritance tax is typically payable at a rate of 40%. However, there are certain ways of reducing the 40% tax rate, which we'll discuss during our second webinar. So who pays inheritance tax? For individuals who are UK domiciled, in other words, they see the UK as their homeland, inheritance tax will be charged on their worldwide assets. This means that their estate will include not only the assets that they own in the UK, but also those assets that they own abroad, such as holiday homes. For those not UK domiciled, it is possible to be deemed UK domiciled. This is through meeting certain criteria, such as spending a certain amount of time in the UK. For those that are deemed UK domicile, they too will pay inheritance tax on their worldwide assets. For non-UK domiciled individuals, they will pay inheritance tax on their UK assets only, meaning any assets based abroad will be ignored for UK inheritance tax purposes. Now, the rules regarding domicile are complex, and therefore it's important you seek advice if you're unsure of your domicile. In terms of who pays the inheritance tax, it's those who are dealing with the estate. So where there is a will in place, this will be the executor. Where no will exists, it will be the administrators. The inheritance tax that is paid will effectively reduce the value of the estate that's available for distribution to your beneficiaries. Now, if individuals have made certain gifts during their lifetime, there are occasions when the recipients of these gifts will be required to pay inheritance tax. Or indeed, the gifts can impact the amount of inheritance tax levied on your estate when you die. We'll discuss the various types of gift that can be made and the pros and cons of these during next month's webinar. And really importantly, inheritance tax needs to be paid before probate can be granted and your estate distributed. It's often advisable to try and settle the inheritance tax liability within 6 months after the individual's death to avoid paying interest on the liability. So I mentioned during the first couple of slides that there's certain reliefs that are available to reduce your inheritance tax liability. So let's have a look at these. Firstly, and perhaps most importantly, we all have £325,000 that we are able to pass on to our beneficiaries without tax. This is known as the nil rate band. The nil rate band has been fixed at £325,000 since April 2009, and it is currently frozen at this level until April 2026. This is an individual allowance, meaning married couples and civil partnerships will each qualify for this, meaning as a minimum, they will have £650,000 that they are able to pass on without tax. In addition to the nil rate band, individuals may qualify for an additional allowance, known as the main residence nil rate band. This entitles you to a further allowance up to £175,000 each. However, it has to be offset against your main residence. Now, unlike the nil rate band, not everyone qualifies for the main residence nil rate band, and there are certain conditions connected with the main residence nil rate band. So, for example, the property itself must be your main residence. It can't be offset against a buy-to-let property. In addition, the property must be passed on to your direct descendants. This means your spouse, children, and perhaps grandchildren, but importantly, it doesn't include other family members, such as parents, nieces, or nephews. Also, the main residence nil rate band is potentially reduced if your estate exceeds £2 million. The main residence nil rate band can be complex, and for further information on this, please read our guide on our website. In summary though, a married couple or civil partnership qualifying for both allowances can pass on an estate worth £1 million without an inheritance tax liability arising. Now, importantly, the allowances discussed are transferable between spouses and civil partners. This means that they are not lost if not used on first death. Okay, so let's have a look at an example calculation for inheritance tax. So we have a husband and wife with assets worth £2.2 million. This includes their main residence, which is valued at £1 million. They've not previously made any gifts, so it means we're just dealing with the estate here. They have liabilities totaling £200,000, which means for the purposes of inheritance tax, they have an estate worth £2 million. In other words, £2.2 million of assets, deducting the £200,000 of liabilities. So they'll each qualify for a nil rate band of £325,000 each. In addition to this, they've decided to leave their main residence to their children, which means they'll each qualify for a further £175,000 each, their estate not exceeding £2 million. So in summary, they'll have total allowances of £1 million. Once we deduct these from their estate, they have a taxable estate of £1 million. Now, inheritance tax will be payable at a rate of 40%, which means HMRC will receive £400,000 from this couple's estate. The remaining £1.6 million can then be distributed to their beneficiaries. So if we look at this example, HMRC will receive 20% of the client's total wealth that they have amassed on their death, a significant amount of tax. Now, as I mentioned earlier, many of the rules surrounding inheritance tax have been around for some time, and importantly, that includes the nil rate band. Now, whilst house prices and stock markets have grown significantly over the past decade or so, none more so perhaps than the past 12 months, the nil rate band has remained anchored at £325,000. Despite the introduction of the main residence nil rate band during 2017, inheritance tax receipts have continued to increase. They reached a record £5.3 billion during 2021. This has meant that it's becoming a greater issue for greater numbers of people than ever before. No longer is the tax simply payable by the wealthiest in society. Now, with asset prices continuing to increase but inheritance tax thresholds remaining fixed, it's predicted that inheritance tax receipts will continue to increase. Current projections are for receipts to reach £6.3 billion by 2023-24. Now, the eagle-eyed amongst you will notice a drop in the figures during 2008-2009. The reason for this was the introduction of the transferable nil rate band between spouses. Prior to this date, any nil rate band not used on first death was lost. Now, I think that covers off the main facts and points around inheritance tax, and I hope you found the webinar informative. Now, to whet your appetite for the next webinar, I want to leave you with this thought. Chancellor Roy Jenkins once said, "Inheritance tax is a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue." Now, during our second webinar, we'll discuss what options are available for planning for inheritance tax and whether there is any element of truth in the comments of Chancellor Roy Jenkins. In the meantime, should you wish to discuss inheritance tax or review your inheritance tax position, please do contact me and I'd be delighted to discuss this with you.